Hello everyone, present here virtually. I am Nalini here and I welcome you all for today's session which is titled as Financial Restructuring Unlocking the Value. And presenting this session we have with us our today's expert Srimui Guha Roy. Srimui Guha Roy is an assistant professor in the morning section in the Department of Commerce in St. Xavier College, Autonomous, Kolkata. She has a PhD in a commerce, specialized in accounting and finance from University of Calcutta. She she also has MBA and MCOM along with UGC NET qualification. She is registered as a PhD supervisor in commerce in St. Xavier College, Kolkata under the University of Calcutta. She is also a guest lecturer in the University of Calcutta and many other noted postgraduate disciplines in various other colleges. Her primary area of interest is in strategic management, human resource management, Indian financial market and financial instrument, microfinance and financial inclusion, financial reporting and CSR amongst others. She is also an associate editor of several international research journals. She has an teaching experience from 2009. She has published over 40 scholarly research paper in various peer-reviewed national and international journals. She has also presented over 30 papers in various international and national conferences. She has also received the Best Paper Award at an international seminar. She has been awarded Outstanding Professor in Accounting and Finance at the National Leadership Award 2019, organized by Orbit Services Private Limited. Her debut book, Micro Insurance, including the excluded, was published in October 2015. She has a total of 7 books to her credit. You may start now, ma'am.
Yes, I'll start. Okay. Thank you for Nalini for introducing me. And I really thank Research Circle for giving me this platform to share my knowledge, whatever limited knowledge I have on this particular topic. And I'll try and make it interesting. And I would like you to, if you have any questions, the participants, if you have any questions, you can stop me and you can ask questions, no problem. Or you can keep the questions for the end. And Nalini, could you tell me how much time do I have?
Around
1 hour. Around 1 hour, right? Okay. So I'll start. So the topic is financial restructuring, unlocking the value. Now, before starting with financial restructuring, let's focus on the word what restructuring means. Restructuring is made up of the word re and structure. So there is already an existing structure. On top of that, you are trying to now restructure it. So first of all, the main prerequisite for restructuring is that you should have a structure in place first, right? Then only you can go for the restructuring, first and foremost. And here in this particular topic, we are focusing on financial restructuring. So financially, you're going to restructure your organization, right? And obviously, that is a very big decision. And that is a very, very huge decision that can have a very, very huge impact on the organization, right? So that is why this decision, that is why with this we are using the word unlocking the value. So there is a major value change also that might bring in after restructuring. We cannot say that restructuring will be a successful move. Restructuring will be an unsuccessful move, right? But that the company has come to a decision that they will have to restructure, right? Why so? Why? We'll first deal with that. Why is it so? Okay. Why do they have to come to a decision that uh, they have to go for restructuring? Okay. So that means automatically they will think of the positive impacts that restructuring will bring, right? So what positive impact? That there will be increase in the value of the firm. Okay. And that is why here we have written unlocking the value. Okay. Now, financial restructuring is actually a very what do you call it? A specific restructuring we're talking about. This entire thing comes under what we call is the corporate restructuring. Corporate restructuring. Under corporate restructuring, there are various kinds of restructuring. One of that is financial restructuring. Okay. So what is corporate restructuring? Because corporate restructuring is a wholesome definition. Okay. So it is a process of redefining. See, everywhere we are using the word re, right? Okay. So we are putting the word, putting the alphabets re, re before it, because that means already there was a definition given. Already there exists such a structure that we have to restructure now. So redefining what? Redefining the basic line of business and discovering a common thread for the firm's existence and consolidation, right? So redefining the basic line. So in simple and layman's language, that means the company was facing some kind of problem, some kind of uh, issues, some restructuring. Why is it required? Okay, so there was some kind of what do you call it? The company has suddenly stumbled on certain thing, and for because of that, they want to redefine and restructure their organization. Okay, so it is a process by which a corporate enterprise tries to alter its course, refocus itself to specific performances, right? And it does it after obviously doing a detailed analysis of where is it now, where does it want to be. Okay, why do I want to restructure? There are various factors that may be playing, right? Because of which the company is going for restructuring. So company is currently at what position? After restructuring, the company sees itself at what position? Okay, at what state? Right? Okay. So that means you have to do a detailed analysis. That is restructuring required. Why do you have to do a detailed analysis? Because it is a very big decision that you're taking for the company. Very big in the sense that it obviously it will have to incur a lot of cost, right? You have to invest a lot of time, energy, expertise, right? And you're going for this. So obviously that you're investing so much of money, of time, energy, resources, other resources, right? Obviously you expect to have a good outcome from it. Okay, so that is why first analyze where you are, where is the company right now, what position, what is the rank of the of that particular company in its own industry. Okay, how has it performed in the last 2 years? Obviously overnight you will not take the restructuring decision. There has to be several factors that are working, and obviously accumulation of the factors, you take up a decision of restructuring the organization. So it's a very big decision that will have an impact on all aspects of the organization. So you have to be very careful, and you have to be absolutely top management. When I'm saying you, I'm talking about the top level management, has to be absolutely sure of it, that it will bring in positive results. Okay. Now, if I place a company who actually thought of what do you call it, restructuring, but after that lockdown hit, after that a pandemic hit, then obviously these are abnormal situations, right? Okay, then whatever you had actually foreseen for the company may not come true. Okay, but these are absolutely unfortunate instances. But generally Generally, when a company goes for restructuring, obviously the result you think, you envisage, is obviously should be better than what it is right now. Okay. So restructuring would radically alter a firm's product market mix, capital structure, asset mix, and organization to enhance the value of the firm. So it could be of various types. As I said, it could be of various types. It is not only about restructuring financially. There could be others. Okay, from the management point of view, altering the product market mix, which product, how much market share, okay, you're working upon, right? Changing the capital structure, changing the asset mix. You're going to move from you're going to move to a more automated company, so asset mix of the company will also differ. Okay, so there could be various forms of restructuring. Okay, and you have to know your own core competence. Okay, because obviously you are, as I said, investing in so much of your resources, so you have to know that what type of business the firm can do most effectively. The firm has the competence in identify that. Okay, identification of that. Okay, very, very important. That is the most important part of the structuring, because otherwise it will not give the best results, the results that is forecasted, it will not give. Okay, so first of all, that what you are good at, what the company is good at. Okay, so those business or market areas which offer little or no potential, that can be shut down. That can be the earnings from the whatever, you can sell it off. Those business units can be sold off, right? And whatever little money you can get out of that, you can actually invest in some other. Okay, the more important ones, the more successful ones, right? Okay, so little or no potential should be removed from the basic business structure. Others having unsatisfactory earnings, poor competitive position, or management incapability should obviously be discontinued, right? Okay, so that also understanding, deciding firmly which ones are doing good, which ones are not doing that good. Can we let go of this? What impact will it have on the profitability? Right? Obviously, if a business unit does not do good for 1 quarter, 1 year, you don't come to a decision. But it is for a longer period, continuously, you have to push in money into that to make it work. Right? So in those cases, it is better that you know, that you identify which business units you can continue with, business units you can actually put a stop to. Okay, so that is also obviously a type of restructuring. Okay, now next, this is the process. Okay, this is the restructuring process, not financial restructuring, but restructuring process. So see, first, assess the situation. As I said, assessing situation, very, very important. Okay, where you are now, from all aspects. Why is the employee turnover of your company so high as compared to other companies belonging to the same industry? Why is the product not the size of the market for your product has not increased for the last 2 years? Even if you are giving it, it's an FMCG product, it's a what do you it's a perfect competition market. Okay, but still the share of your product has not increased. It's not a perfect competition, maybe some other product that you have, another product line that you have. Okay, so deciding on all those factors and assessing the situation. Are you at a worse situation? Will it get even worse? Will it worsen more? Or things are looking better after maybe after the next quarter? So So you think that you have come up with an plan, you've come up with a strategy, so something, a unique proposition, a unique product feature, right? That obviously will change the market size of the product, and automatically you will mean, and you also have to work on the employees welfare, so that you can keep you can reduce the employee turnover. That is also not a good sign, right? So you assess the situation. Can the situation be fixed with uh, a better strategy within the organization and not going for restructuring? Can the situation be fixed with certain no, usual steps, certain usual ways to deal with the situation? I hire a consultant from maybe I give the work to a consultant, okay, but I am not going for a major restructuring process. Okay, so that could be one way of looking at it. Another way, no, not one way, but this is one aspect. Another thing is that you assess the situation and you see that nothing will be good from now onwards, things will worsen. So in that case, you will have to go for a restructuring process. But if you assess the situation wrongly, then the restructuring will also not give you the best of benefit. So assessing the situation, understanding the situation the organization is in, is a very, very important analytical step. Okay. Next, increase net asset turnover, sell non-operating assets, operational improvement. These are the steps that the company can take. What? Increase the net asset turnover. Okay. The non-operating assets can be sold and whatever money can be got out of it. Operational improvements, you try to bring in some operational improvements. If those work, then problem solved. Yes, you come down, continue with success of the business. If that does not work, then you go to the next step, which is the debt and capital restructuring. If that works, you go into the next. That means, yes, it does work. Yes. So again, continued success guaranteed. If that doesn't work, sell operating assets or divisions, right? If that works, because you're going to get some, the company will be in a liquid position after selling off the operating assets, and with that they can pay off their dues. Okay, and did that work? Yes. So continued success. If that doesn't work, that means you declare yourself to be bankrupt. Because assessing the situation, main thing is that you do not have enough funds. That is the crux of the matter. You do not have enough funds to carry on operations. So that means what? You do not have enough funds, cannot happen overnight again. So that has been this position that you have arrived at was due to accumulation of various factors, continuously working against the company. So the company did not do good with the product. They tried to push the product into some other segment. They did not work there. They tried to bring in some changes into the product and relaunch it. Everything requires money, but you're not getting the revenue out of it. So you are going on pushing fund, but you are not getting anything in return. So this process is absolutely in layman's language. I'm trying to explain it to you, right? So it boils down to the situation that you no longer have funds. You have a bad reputation in the market now. Now no one is going to give you loan, right? No institution, right? No one is going to give you loan. So you have lack of funds. What do? You sell off the divisions. Now, when are you selling off the divisions? When you're already tried and tested with other strategies which has failed. So your business will not, divisions that you're selling will not give you that much of money as it was, so the value of your divisions have fallen. So you're not going to get as much of money as it should have got if it would have run successfully. Right? Clear? So in that case, you declare yourself to be bankrupt. After that, after declaring yourself to be bankrupt, there is a certain process with that. Okay. And you can, after declaring, you may get some help. Okay. That might work, or else final liquidation of the company. So restructuring is the way to hold back a company to go into liquidation, holding back. Okay. Right. So that is why restructuring is very, very important, and financial restructuring, obviously. Next, motives for restructuring. What is actually leading you to restructure your company, right? Okay. So first and foremost is the government policy. So the government policy of what? The government policy of liberalization, privatization, globalization, okay, which may help the Indian organization to restructure their product mix, market technologies, okay, so that they are in a position to meet the competitive challenges in terms of cost, quality, and delivery, okay. Strategy of accessing new market, entering into new customer segment. Convertibility of rupee has encouraged many medium-sized companies to operate in the global market. So these are all the government policies. So see, when I'm thinking of restructuring, there has to be some government initiatives also being taken, government laws, policies being framed, right? So there has to be some kind of infrastructure provided by the government, right? Clear? So those are very, very important. So first and foremost, first motive is to get the benefits of the government policy. The government policy says that if you build up if you start a convention center in NCR area, you will be actually getting tax holiday, right? If you set up a unit in the SEZ area, you will be getting a tax holiday. If you set up a unit in the backward areas of certain states, you will be getting a tax holiday. So for those cases, and there are certain cases, the what kind of product you will be manufacturing there, what kind of services you will be providing there, that is also mentioned by the government in the government policy, right? So you may have to deviate from your own from your core product line into those product line so as to get the benefits of tax holiday. So one of the motives for restructuring is obviously government policy. Okay. Second is the revolution in IT. Okay. That is information technology restructuring is also very. You try to use the technology into your advantage, right? So revolution in IT facilitate companies to adopt new changes. Okay, so that is also your IT restructuring. Okay, so there are so many ways, right? By sitting at home, you can start a business, you can do your business, right? If you use and the facilities of IT, right? Okay, so in that case, that means the starting cost will be much less, right? Okay, and if a company already in existence, they want to shift to a completely IT led processing, obviously that has various advantages, right? So in that case, this is called the revolution of IT, obviously has one of the major motives for restructuring. Because why can we say that this to be a motive for restructuring? Because that means it has more advantages than disadvantages. Okay, it has more advantages than disadvantages. Okay, lastly, any kind of wrong diversification. Okay, you've taken a wrong decision for diversifying, right? And has led many organizations to revamp themselves. New business embraced by companies in the past had to be dropped because of their irrelevance in the change environment. Right? So there are various wrong decisions that you have taken, which has impacted your company very badly. Right? So making those decisions right, coming out of those decisions, right, is also a kind of restructuring. Okay. Product divisions which do not fit into company's care business are being divested. You do not any longer want to continue with those divisions, right? Okay, because those have not given you the what do you call it, that has not given you the what you had forecasted from those division, how they will be performing, how they will be doing, right? Okay, so that they have not given. So in that case, you will have to let go of them. Okay, so that is also one way of one of the major motives for restructuring. Okay, improve productivity. Obviously, if I'm going for such a huge decision, if it does not have the benefits attached to it, why will I? Improve productivity and cost reduction have necessitated downsizing of the workforce. Another reason for restructuring is improved management, right? You want to bring in change in the management, the span of control, who reports to whom, how it reports, from a traditional organizational structure to a much more fluid organizational structure. That is also a type of restructuring, right? At times, organizations are motivated to reorganize their financial structure for providing a financial strength and improving operating performance. The last one talks about financial restructuring. Okay. So see, these are the different types of restructuring. Financial, which includes acquisition, mergers, your leverage buyout, leverage recapitalization, reorganization of capital. Technological restructuring, that means you are trying to use the benefits of the technology and trying to implement that completely in your business, right? Together with that, market restructuring, product mix, right? Organizational restructuring, right? Downsizing, closing down of units, the reporting, accountability, answerability, and the flow of information, right? Working on those, that is also called restructuring. That is why I said from the very beginning that restructuring means there is a structure already in existence. Now you're trying to redefine that. From what ways? From financial way, from the market point of view, from the organization point of view, from the technological point of view. And there are many more. These are the 4 main broad ones, but there are various others as well. So we start with the financial restructuring. So it's an initiative. See the keywords which define it. So it is a specialist initiative undertaken to reorganize the financial assets and liabilities of the business enterprise in order to make. So whenever we talk about financial restructuring, think of the balance sheet, think of the profit and loss account. What changes can you bring there? And that is exactly what restructuring. Your debt equity ratio is 2:1. You want to change it to 2:2 equal. You want to make it equal. That is restructuring. You want to increase your component of total fixed assets of the company, right? You will be working with the current assets, current liabilities, the components of the current assets, the different types of current assets, right? All those, how much will be the total component of current assets as compared to current liability, as compared to fixed assets, right? The proportion of it you would like to change, right? And so this is one of the major ways of defining financial restructuring. Okay. And next one, with inefficient restructuring. Inefficient, if it does not work, if it does not work. Okay. So with inefficient restructuring, companies are often entitled to favorably change their relationship with lenders, shareholders, and other stakeholders. Okay. So when inefficient restructuring means efficiently, that means everything as per the process, rules, regulations followed, everything kept and done. Inefficient restructuring means companies are, when they want to favorably change their contractual relationship with the different stakeholders of the company, from lenders, shareholders, other stakeholders, right? The terms with them, the terms of conditions with them, changing that, changing the credit terms, right? Changing the when to return the money, how to return the money, how much dividend will you be paying. So working on this so that you have a healthy relationship with all different types of stakeholders. Okay, so it's a type of corporate action, another way of looking into it, that looks to modify the debt operations and structure of the company. As I said, that changing the debt equity ratio, right? Changing the different, working on other different types of ratios and getting a favorable results from that. Okay, and has to carefully balance between debt and equity, and these two factors are which are influenced by, obviously, by the business condition, right? Okay, now what is the need that may arise for the manager? See, we have done the motives behind restructuring, that is a general overlook, but for financial restructuring, this focuses on the financial restructuring, right? So what is the need that may arise for the management to do restructuring financially, right? So in that case, you have inability, first one, inability to meet the current commitments. As I said, ultimately it boils down to insufficient funds. Ultimately it boils down to that. That is the crux of the matter, right? So inability to meet the current commitments. Okay, that means you do not have enough funds to even meet your current obligations, right? Underutilization of existing production capacity. You do not have that market size, that market capture. Why will you be using a full production capacity, right? So you're underusing it. So that means you have some idle capacity, right? And you do not see, it's a vicious circle. You do not have a proper market share given your product, and you do not have the funds to increase the market share as well. You have to go for advertisement, you have to penetrate into new market, right? But for that you need money, you need funds, you do not have that. Okay, injecting more capital for meeting demands from customers. So where you need more capital for meeting the demands, so you need funds. Restriction on obtaining further credits. As I said, you have earned a bad reputation in the market, right? Your product is not doing well for a long period of time. You have tried to bring in changes in the product, in the services, in the ways to deliver the product, the pipeline. You tried to work on it, but it has not worked. And meanwhile, what has happened? You have given up. You have given too much of. You have invested too much, right? So you do not have enough funds. And it is not that these. First of all, these are not the only 4 points. There are various other points, but I thought that these are the 4 main points. First of all, that I've given in this particular slide. Firstly, secondly, it is not that at a given point of time, only one factor will be working against your company. As I said, there will be it will be attacked from all different types of factors. right? It is accumulation of all different types of factors that work, right? And that will impact your company. So you may have strategy ready for maybe if you cannot meet your current obligation, you may have certain strategy to overcome that. But there are the other three factors also working against the company, for which you are not ready, for which you are not prepared, and you do not know how it will be impacting. So which factors will impact you, how, you do not know that. Which factors you have to give more weightage to, you do not know that, right? Unless and until you are in that particular situation, you are unable to decide on that. And which factors will be actually you are ready for, and by banking that factor you are overlooking the other factors, right? So it obviously ultimately it brings down, ultimately it boils down to that you have to go, the company has to go for financial restructuring, right? Okay. So now we'll come to the process. Need, we've done, right? And next we'll do the process of financial restructuring. Okay. So it is, the process is more or less the same, because these restructuring basic steps of the process is the same. Okay, clear? So that is why it is sometimes correlated with, you can correlate it with the corporate restructuring, right? And in case of corporate restructuring, the company's general function composition is likely to have an impact on the financial restructuring as well. Okay. So steps. Next is steps. So steps, generally I've shown you the major steps that assessing the situation, and from there how can you come out of the situation. If that doesn't help, then in that case finally you declare yourself to be bankrupt, right? But assessing and understanding, okay, that itself is a huge process. Now those points I'm further dividing into. Okay. So first step, see, step number 1, what are you trying to do? Detailed assessment of short-term and long-term cash requirement. Understand how much do you need, how much you're lacking now. You need to come out of it. For that you need cost, and then over and above that you need funds to sustain. Over and above that you need to do well in the market. Over and above that you have to pay all your dues. Over and above that, so ascertaining that short term as well as long term cash requirement, how much is it? Okay, that is why I said from the very beginning, where are you now? Where do you want to see, where do you want to see your organization 5 years, 10 years down the line, right? And obviously taking the best decision based on that. Okay, taking the time value of money into consideration, taking the business performance, how the business you likely to perform, building scenarios and understanding if these are the if these kind of market, if this kind of scenarios happen, that suddenly there is a decline for the product in the market, then in that case what do? Suddenly there is a huge increase in the demand. So you build scenarios and you be prepared if such scenarios occur. So how many scenarios are you prepared for? Right? All relevant stakeholders need to be immediately identified and mapped into various categories so they accord their approval to move to the next step of financial restructuring. Okay, it will protect value and avoid risk or possible insolvency of the company. So firstly, how much requirement you have, ascertaining that. Second, understanding the different groups of stakeholders. Understanding that they are the main ones who run the company, who helps in running the company rather. Okay, and without whom it is difficult. It is extremely difficult. You need them, right? So understanding that. Thirdly, Stakeholders may plan to challenge underlying assumptions, which includes understand the reasons for underperformance. Obviously, they will ask questions. They are the stakeholders. They have the right to ask questions, right? Okay. Right to ask questions regarding what? Regarding underperformance, which may involve interaction with the management team to devise suitable strategies, initiatives, and the company's business plans. Right? Okay. Next, company should develop more than one plan. Always. Always. And that is exactly why I said building scenarios. Okay. When we have done uh, capital budgeting chapter, remember that you have three options in front of you, right? And from those three options, you select the best suited option, not the best looking option, but the best suited. Okay. Now, numerically, when we used to do the sums, obviously we used to choose the option which used to give us the highest NPV, right? But there other factors we never considered. We only consider the factors given in the sum. But in reality, there are various other factors that needs to be taken into account over and above the positive NPV. Right? Okay. So in that case, obviously, how much? So that is why which plan is best suited for the company that we have to do. So appraising the plan, assessing the plan, and negotiating with it. Okay, what can be brought down, what can be increased, what can be taken to remain at as constant, right? Okay, so all these factors needs to be taken into consideration while evaluating the different plans, while evaluating the different factors, and choosing the best alternative given the nature of the company, given the size of the company, given the type of products, given the industry it belongs to, given the ranking of the company, all those factors and various other factors, and given the time at what life cycle the organization is in right now, right? What stage of the life cycle the organization is in, right? So given all those, you choose the best suited plan for the company, right? So financial restructuring is a proposal that should be prepared considering efficient processes, preserving value. You don't want to diminish. You don't want to diminish, preserving or enhancing, and tax efficiency. As I said, building up a convention center, hilly areas, building up a hotel, right? Backward areas of certain states where starting a company there, what kind of products you cannot, what kind of products you should, what kind of services you should, vocational training courses, your hospitals, nursing homes, right? What kind of business you can set up there so that you get tax holidays, so tax efficiency, okay, and efficient processes. Okay, right? Tax efficiency. I can give you a small example. Like suppose you're restructuring a business and you need a certain kind of asset to be procured. Now, this certain type of asset that you're going to procure, how? You can do 100% cash down. You can take it from. You can purchase it by a bank loan. You can purchase it on hire purchase. You can purchase it through a lease. How? Each of the 4 plans has a tax consequence attached to it. If it's a loan from the bank, I'm going to repay the asset in installments. And how I'm going to arrange the funds? I'm going to take a loan from the bank. So what am I doing? I'm paying interest, which I can charge to my profit and loss account. And since I'm purchasing the asset through a bank loan, I am owning the asset, so I can charge depreciation on the asset. But for hire purchase, the asset does not become mine unless and until the last installment is paid. So if the asset is not mine, I will not be able to charge depreciation in the PL account. Yes, I can show higher charges in the PL account, but not depreciation. Is it clear? So When I'm taking a decision, I have to consider the efficient processes. What change will it bring in the processes, operations, manufacturing, that part, preserving the value and tax efficiency. So these major factors needs to be looked into, because see, you are in a problematic situation. See, restructuring does not always mean that you are in a bad situation, but more often than not, it is found that the company which goes for restructuring is in a bad situation. Okay, so when you have restructured yourself, in that case, you do not want to see yourself in the same position like you were when before restructuring, right? So you obviously want to see yourself as in a better situation. Okay. Next, change in economic environment, new developments and demands from stakeholders may necessitate that reworking of the plan. Okay. Now you worked out a plan, you've chosen a plan, but the plan needs to be flexible. The plan needs to be flexible so that you can bring in some changes in the plan. New developments, demands from stakeholders, right? So that you can rework on the plan and make it more suited, more aligned with the organization. Okay, it is a unique plan for your organization which is going for restructuring, right? So in that case, that plan has to be perfectly suited with the organization. Okay, now what are the different types of restructuring? Okay, now all of you are majorly familiar with these terms. Okay, so in that case, see, the first one is mergers and acquisition. You're familiar with these parts. Okay, so the concept of mergers and acquisition is what? A company intended to acquire another company may buy the assets or stock, or may combine it with the latter. And acquisition of an organization is accomplished either through a process of merger or through a takeover route. Okay, so merger is a coming together of two companies into a single company, where one survives and obviously the other loses its identity, right? Takeover is a purchase of the company of a controlling interest. Okay, so takeover is more to do with the acquiring the controlling interest. Okay, why go forward? So these are the types of financial restructuring. We have talked about what is financial restructuring. We talked about the need for financial restructuring. We have talked about the motives of financial restructuring, steps. Now, how is it done? How is it done? First, merger is a type of financial restructuring. Takeover is a type of financial restructuring. Okay. And what is the motive behind mergers and takeovers? To avail operating economies. Okay, so which you did not have previously, that is, firms are merged to derive operating economies in terms of what? In terms of elimination of duplicate facilities, in terms of reduction of cost, in terms of increased efficiency, better utilization of capacities, and adoption of latest technology. Okay, so these are so you try to avail the operating economies of the of the gains of the merger to achieve accelerated growth, which was not maybe the growth of the merged firm before merging. So the growth of the merging firm, right? Okay, may not be as much. It was a slow snail speed growth. Okay, so they want to accelerated growth, right? That is a growth at a higher rate than which was accomplished through its normal process of internal restructuring. So the company went through internal restructuring, did not work out. So now they're going for financial restructuring, which is mostly external restructuring. Okay, to take advantage of complementary resources, the resources that you do not have abundantly access to, right? But through this merger, you can get access to those kind of resources, and these kind of resources will be extremely helpful for your company, for your organization to either it could be a backward linkage, forward linkage, okay, to speed up diversification, okay. By merging with relatively more stable enterprise, a company is prone to a wide cyclical swings may be able to minimize the degree of the instability. Okay, to speed up the diversification. You do not want to focus your entire resources into one kind. So you want to diversify into various other type of products, industries as well. Okay, so in that case, to speed up that, you need to be in a stable position with your successful products firstly, right? Then only you can think of diversification. But if your only thought is to survive and sustain, then diversification is not one of the best option, right? And to combat competitive threats, okay, to combat competitive threats, which the company alone was not in a position to do. But now with a merged firm, with the power of two or more firms, now the company is in a better, the merged company is in a better position to combat these kind of threats. And these are a few other lesser important ones. So they're not lesser important, but these are the other types of the benefits that you can derive out of a merger and acquisition. So to access to latest technology, which was, so you obviously want to be in a situation which you were not previously, and obviously the situation that you want to be post restructuring is a better situation which you were not previously. Okay, to widen the market base, the customer base, right? To strengthen the financial position, to acquire more competitive management, okay, to strengthen the controlling power. So all these are the major benefits out of a merger and acquisition. Okay. See, assessing merger as a source of value addition. Okay. See, look here, I have a small example shown here. Firm X has a value of 400 crore. Y has a value of 100 crore. So Y has lesser value than X. So merging the two would allow cost savings with a present value of rupees 50 crore. So they have given us the gain from the merger. So see, PV, present value of X is 400 crore. Present value of Y is 100 crore. And the gain from the merger is 50 crore. Given, see, merging the two would allow cost savings with a present value of 50 crore. Okay, so there is a gain. So the present value of X and Y put together is present value of X plus present value of Y plus the gain from merger, which is coming to 550 crore. Understood till here? Now suppose that firm Y is bought for cash 130 crore. Then is what happens? Cost of the merger becomes what? X is merging with Y. Y's value is 100, right? And X is paying 130 for it, more than what the value of Y is. Okay, so that is the cost of merger. That is 130 minus 100, that is 30 crore, right? So now the net gain is not 50, but it gets reduced by 30, and now the net gain is actually 20 crore, which is still positive, and hence we can say that the merging is a successful strategy for the given situation, right? So still the gain is positive, and we can say that merging is a successful strategy is going to be a successful strategy for the company, right? Okay. So now this is understood, this part. So this part only in theoretical he have written here. Determine economic gain from the merger, which was given in our sum. Determine cost of acquiring from firm Y, that which is given 130 in our sum. Determine the net present value of X of a merge with Y. If the difference is positive, go ahead with merger. Go ahead with the merger. Clear? Next one. Divestitures, types of, this is also first type of merger that first type of financial restructuring that we did is mergers and acquisition. The second one is this one, divesting. Okay, so divestitures, this is while mergers and acquisition lead to expansion in some way or the other. Okay, this involves some sort of contraction of business. Okay, so you identify the units, right? You are trying to transfer those units. Okay, so it's a form of corporate restructuring which signifies a transfer of ownership of a unit, transfer of ownership of a division or a plant to someone else. So which divisions are, so you are remaining with the, you are actually with the most successful ones. Okay, you are with the most successful ones, you retain the most successful ones, right? And you try and assess that the ones which are not doing good, for which you are incurring more costs than what revenue is coming out of it. So you try to transfer the ownership of that particular unit, that particular division, right? Or that the particular plant to someone, you divest those. Okay, so that is a reverse of in. So it is a strategy generally by highly diversified firms, because as I said, you retain some, you give up some, right? Okay, so that means you have many diversified firms. Otherwise, this method will not work. If you have only one type of firm and you're giving that up, that means you are merging or you are being taken over, right? So this prerequisite for divesting is actually that you have many. You have various other kind of what do you call it? You have various other diversified firms, which you have obviously difficulty in managing, and have elected to divest certain of their business to focus on the more important ones and with on the ones on which you have a core competence. Okay, these free resources that can be used to reduce debt. Whatever money you get out of the divesting strategy, you use to repay your debts, reduce your debts. You try to put this money into the more successful firms that you are going to retain, and you won't try to expand that. Okay, because you know that. So you try to expand your core business by giving up the ones which were not your core business, right? Okay. These are the steps that is followed for divesting. Other than this, you have the leverage buyout. Okay, that is a type of financial restructuring. So this is also an important form of restructuring, which represents transfer of an ownership which is consummated heavily with debt. Okay, that is why it is called leveraged buyout. The term leveraged is given there. Okay, so leverage buyout involves acquisition of a division of a company or sometimes other subunit. You can understand this with the help of this particular example. So Limited has 4 divisions: chemical, cement, fertilizers, and food. The company desires to invest the food division. What do they want to do? They want to divest the food division. They want to give up the food division. Okay. Why? The assets of the division have a book value of 240 lakhs. The replacement value of the asset is going to be 340 lakhs. If the division is now liquidated, the assets would fetch 190 lakhs. Okay. So this is the current situation. There are 4 divisions. They want to divest the food division. Now, MML has decided to sell the division if it gets 220 lakhs in cash. So they have agreed that even though their asset value is 240 lakhs, but they are going to give up even if they get 220 lakhs. Okay. The 4 top divisional executives. There are 4 divisions. So 4 top executives are there, right? Who are willing to acquire the division through a leveraged buyout. How do they work? How do they plan to go about it? They are able to come up with only 6 lakhs in personal capital among them. So they have invested 6 lakhs. What are they trying to do? They are going to purchase the food division. How much could they arrange for? They could arrange for only 6 lakhs from their own pocket. They approach a consultant for assisting on this project. Okay. What do the consultant do? He prepares projections for the food divisions on the assumption that it will run independently by the 4 executives. Now they are taking it up. The 4 divisional executives are taking it up. On what grounds? They have to know well that the division will do good. So for that, they've hired a consultant. Okay, so consultant works out that what will be the time value of money, what will be the major cash flows, taking into account the time value of money, right? And for the food division, on the assumption that it will run independently by the 4 executives. Okay, so independently meaning that will have no attachment with the major company MML Limited. The consultant works out that cash flows of the division can support debt of rupees 200 lakhs. It finds a finance company that is willing to lend rupees 170 lakhs for the project. It has also located a private investor who is ready to invest 24 lakhs in the equity of this project. I'll just go through this part again. The consultant works out that cash flows of the division can support debt of the rupees 200 lakhs. Okay, so the cash flows from the division can support up to 200 lakhs rupees of debt, and it is willing to lend 170 lakhs for the project. And it has also got equity 24 lakhs. Thus, the food division of MML is acquired by an independent company, which is going to be run by 4 key executives, which is funded through debt to the tune of 170 lakhs and equity participation of 30 lakhs. This is leveraged buyout. This is leveraged buyout. Understood? Okay. Next, leverage recapitalization is another form of financial restructuring. So it is a process of raising funds through increased leverage and using the cash so raised to distribute to the equity owners, right, by means of dividend. Okay, so it is a process of raising funds to increase leverage and using that cash so raised to distribute to the equity owners, often by means of dividend. Okay, management and other insiders do not participate in the payout, but take additional shares instead of that. Okay, so this is another way of another type of financial restructuring, right? Okay, now Nalini, I will be taking another 10 minutes. Is it okay?
Yes, ma'am.
Okay. Financial restructuring and business turnout. This part I just want to focus on, these 3 slides. Okay. Now, see, this is given by Deloitte. Okay. Now, this is during the pandemic financial restructuring, because this part also I wanted to focus on, that financial restructuring and the pandemic. Okay, so different solution. Deloitte gives out solutions, right? Okay, to different organizations who are facing distress. So different solutions to handle all intensities of the crisis impact. Okay, so see, vertical axis, they have taken company performance and health. Okay, company performance. Horizontal axis, taken the level of influence. From left to right, if you're moving from management to creditors. The influence on the management to the influence on creditors. From left to right of the horizontal axis. Okay. Now, so here the health of the firm, see, health of the company. Okay. From if we judge at each point, okay, how does it look like? So crisis, see here, the last umbrella. Okay. There, what have they written? The potential solutions there are administrative, receivership, and liquidity. So here the influence, the health of the company is also low, and the impact is level of influence is high and much to do with the stakeholders. So in that case, what are the potential solutions in these cases? That major administrative changes, receivership, or liquidation, right? The bulb part, see. Distressed merger and acquisition, because the company is not doing good. So company will not be getting good value for if they go for buyout now. If they are merged or if they're taken over, they'll not get good because the performance of the company is not well, and the influence of the level of influence is also quite high. So in that case, sale of assets to our network of investors, develop information memorandum, sell it off as a going concern. Now see the next one, which can be done can go to both ways. Independent business reviews, independent financial analysts can be appointed. So here there is a huge scope for recovering. Okay. Now, and this is detection of the warning signs. See the first one, the green one. So these are detection of the warning signs, right? So that means that you are in a bad situation. You are if you do not handle now properly, you may enter into situation which may be out of your control. Companies out of. So there are certain warning signals. If the company tries to if the company tries can handle it right now, okay, properly, then they will not be entering into the other they will not be going down the curve anymore. Okay. And Deloitte offers a comprehensive suite of restructuring services, combining Deloitte's business startup capabilities and network within in-depth industry expertise. Okay. So what do? They go for performance management, distressed mergers and acquisition, financial restructuring, see, and insolvency and liquidation. Let's look into the financial restructuring part. So they help in underperforming business that are unable to meet their near-term financial targets. They help them to identify and capture opportunities, the impacting costs, the relevant cost, earnings before interest, taxation, depreciation, right? Cash flow. They help to performance review and opportunity assessment, which opportunities they can grab, they can grow with, cost reduction and working capital improvement, cash management, turnaround planning, how can they turn around the business completely, independent business review. So these are the services that is provided. Okay. So because I wanted to end with who provides such services. Okay. So our COVID-19 solution, the diagnosis. So where are we? Poor business performance due to COVID-19, baseline financials only, performance gap, what you thought, what actually the results are. So there is a huge performance gap. Okay. What is the impact of COVID-19? Operational disruption, financial uncertainty. These are the terms that you're already familiar with. Staff quarantine, supply chain features, orphaned and or unavailable in inventories, sudden reductions in demand from customers, right? What is needed? Expert financial and analyst, which Deloitte provides, and focus team experienced in driving liquidity, cost out initiatives, right? How can value be preserved? Okay, appointment of independent financial analyst, lean on trusted financial analyst, conduct financial due diligence, right? Okay, so these are the different other these are the in the COVID-19 situation also. Deloitte has come up with innovative solutions to turn around business, to help business in their most difficult times. Okay, so and this is through financial restructuring, obviously, right? Okay, so to sum up, in this particular session, in this 1 hour session, whatever ways I could provide you with information on financial restructuring. So at least by the end of the session, you will be able, I hope you've understood what restructuring is, why is it so important, motives behind it, why is it needed, how is it done, the steps and the types of financial restructuring, mergers, acquisition, takeovers, leverage buyouts, leverage recapitalization, all those, the ways, and types of companies which provide such services. I have put forward here only Deloitte. There are obviously other types of company, various other companies who also provide such services. They provide the financial analyst who takes up the work of turning around the business. Okay. A not so well doing business, a COVID affected business, right? So they are providing such, and this is exactly what financial restructuring is. So it helps so that we do not want business to close down. We do not want it is again a vicious circle. They sustain, we help them to sustain. They also help us with our needs, our wants, satisfaction of our needs, wants, and demands, right? Okay. So it is a framework where if there are no customers, no businesses, no customers, right? So we also need them, they also need us, and they also, so they want them to do well. And financial restructuring is one way of keeping the business alive, keeping the business doing good, not only sustaining and surviving, but also doing well with it. Okay, so with this I complete my presentation. Okay, thank you, Nalini.
Thank you, ma'am. Thank you so much for this very informative and demonstrative session. We will ask our participant to put your question in a comment box. We will try to provide the answer by Dr. Srimoi Guha Roy. Thank you so much all the participants for your active presentation. Let me inform to all that this complete session will be available on our Research Circle YouTube channel. So if you want to watch it again or to share it to somebody, please do visit the Research Circle YouTube channel. Thanks. And last but not the least, thank you, Srimoi Guha Roy, for taking out the time for session. With your permission, I would like to end today's session here. Thank you, ma'am.
Thank you so much. Thank you, Nalini. And I once again, I really thank Research Circle for providing me this platform. And I look forward to working with you in the future as well. Okay, thank you. Shall I exit the meeting?
Yeah.
Okay, thank you. Stop.